As a parent or grandparent, we're often pitched the idea of saving for our kids' post-secondary education right from the time our child is born, if not before. This video is going to look into infinite banking for children and how it's a surprising alternative to using RESPs. We're going to look at a brief history, RESP contribution rules, and more importantly, the withdrawal rules, since they're what can really hurt you financially. I'm going to share with you some actual stories, and I encourage you to stick around to the end, as I'm going to be outlining an important benefit that an infinite banking policy can give your children that an RESP cannot. RESPs were introduced in 1974, so they're less than 50 years old when I'm recording this video. Now, have you ever asked yourself, how did Canadians save for their children's education before this? Would you be surprised to hear that it was with permanent participating life insurance? It was so popular that the Gerber baby food company launched Gerber life insurance south of the border in, 1967. It was insurance benefits and college education plans for children. It seemed to go hand in hand with baby food, so why not? Now, I don't know if I'm fortunate or unfortunate enough to remember going and getting my parents' mail and seeing the Gerber baby's picture on a direct mail piece selling life insurance. When RESPs were introduced back in the 70s, permanent life insurance as a savings vehicle fell out of favor, really for two factors. One, the government gave you grants using an RESP. And two, comparatively high investment market returns seem very attractive. It seems sexier at the time and more attractive to invest your kids' education money in the stock market, take a little bit of investment risk, than put it away into a safe, boring, old insurance policy. So, that being said, let's talk about the grants and the rules involved in contributing to an RESP. Over the lifetime of the RESP, which is about maximum of 30 years, depends on when your kids go to school, you can invest up to $50,000, and the government will give you matching grants of up to 20%, with two caveats. One, the maximum grant they're going to give you is no more than $7,200. And they're only going to match the grant up to $500 per year. So in order to maximize the grants, you need to be a little bit strategic. If you had $50,000 when your child was born, you can't just put the whole thing into the RESP at one time, because you'd only get, a $500 grant for that 1 year's contribution. So if you want to maximize the grant, what you've got to do is put $2,500 in per year, or about $208 per month. But if you start when your child is born, you exhaust the maximum $7,200 grant well before they turn 15. One of the benefits to using an infinite banking concept to save for your kids' education is there's no set maximum contribution limits. Working with an IBCanada authorized infinite banking practitioner, you can design a plan no matter how much you want to contribute. Be that $100 a month, $1,000 a month, even $10,000 a month, you're in control. Why not you decide? The other benefit that RESP providers market to families is the fact that the growth of the money is tax deferred, not tax-free, tax deferred. But don't worry about that. You don't have to pay the income tax on that growth. Your child would. Since they're going to school, they won't have to pay much anyway. Really? But the good thing is, depending on how it's invested, you could probably add it on another 3-5% annual growth to both your contributions and to the grant money. Well, unless, your child needed money to go to school in, say, March of 2020, when the market suddenly tanked. Then the available money could be down 20-30%. Market volatility is definitely a concern, especially when your child gets closer and closer to going to school. Because unlike other financial decisions, it's really not reasonable to tell your kid, no, you know what, you're not going to go to school this year because the markets are down. On the other hand, you don't have to have that worry if you use the infinite banking concept. With every deposit made and every year that the insurance company pays a dividend, the value of the policy is vested and can never go down in value. No market fluctuations. This is why we call the infinite banking concept a savings vehicle, not an investment vehicle, because there's no risk of loss. You can never lose the money. It can only go up in value. Doesn't matter when your kid goes to school, the money will always be there. Let's talk about another one of the RESP rules. If you're investing in an RESP, especially for the grant, it's also true that you have to return those grants back to the government if your child never goes to school. Now, we never think about this since we always want and expect our children to go to either college or university. But you know what? Sometimes life gets in the way and our priorities change. For example, one of my clients' grandson, he's a really good basketball player. It's projected that next year he's going to be offered a free ride to one of the top colleges down south of the border. But the issue is, in order to get maximum exposure to the scouts and get more than one offer, he's got to frequently travel down to the States for tournaments, camps, workout, just to make sure that he's top of mind, make sure that he's seen. Now you might be thinking to yourself, if he gets a free ride, why does he need the RESP grants? Now you might be right, but maybe he gets injured. You never know. And if his parents take the money out of his RESP to pay for this travel down to the States to get noticed, and he doesn't get picked up to go to school, well, his parents are out $7,200. Is that fair? There really isn't any restriction when it comes to an infinite banking concept. You have a contractual right to access the money at any time for any reasons, no questions asked. No fees involved. So if you're an aspiring athlete, maybe a musician, artist, actor, whatever, you have a lot more freedom and control of your money when it's in an infinite banking policy as opposed to an RESP. Okay, let's suppose your child does get accepted to college or university and it's time to use the money to pay for their tuition, residence, etc. Newsflash, that one pot of money you had in the RESP, well, that's actually two, and they both have different rules. The contributions you've made over the years goes into one bucket, and your child can take that money out at any time. The other pot is called the EAP, or Education Assistance Payments. In that goes all the government grants and any growth in your money, like interest and everything else that's gained along the way. There are rules for this bucket, such as in the first 13 weeks of being enrolled in school, your child can only access up to $8,000 for whatever's in this pot. And that money is taxable. Now, after 13 weeks, the student is still enrolled, they can take out the rest of the money. But you know what? Consider this. Quite often when their kids are going to school and that, they want to have a little spending money, so they quite often take part-time jobs. And with minimum wage at over $15 an hour right now, it doesn't take very long until we're over the minimum thresholds and into that 18, if not 26% tax bracket. So much for your kid being in a lower tax bracket later on. Maybe not. It sounds like these rules are simple, but they can come back and bite you. A few months ago, I ran across a family who had their son's RESP at a bank. Now, I don't know if they were advised or whether they made the decision on their own to pay for his college out of the original contributions instead of the EAP. But it was done so their son didn't have to pay income tax. Sounds plausible. But at the end of the 2-year program, the family decided to close the RESP, the son was done school, and take out the remaining funds. Didn't they get a little bit of surprise when they got the money back, and it was $7,200 less than expected? You see, because the son was no longer enrolled in college, that $7,200 in grants had to be returned to the government rather than the family. Because, in the government's eyes, and according to the RESP rules, the EAP wasn't used for their son's education because he wasn't in school when it was withdrawn. This was a costly mistake for the family. And they're not alone. In July of 2023, the Globe and Mail published 2 articles about the perils and pitfalls of not following RESP rules. Now, I'm going to provide links to the articles below. But if you or anyone you know have had to return RESP grants to the governments, I encourage you to share your stories in the comment section below. Before we get to what an infinite banking concept can give your children that an RESP cannot, do me a favor. Hit the like button, subscribe to the channel, and even hit the notification button so you're informed whenever we post a new video. What can using an infinite banking policy provide your child that an RESP cannot? A financial education. With an RESP, once the money is withdrawn and spent while they're in college, it's gone. Spent, depleted, never to be seen again. With an infinite banking policy, you and your child have a choice. Yeah, they can collapse the policy and treat it like an RESP, and then they got nothing but an education at the end. And, well, maybe 2 to 4 years of memories. Or considering that you're giving them a policy and the cash value they have a contractual right to access credit against. At the end of the schooling, they have both an education, the memories, and an asset that keeps on growing. Yeah, you might have a loan against the policy, but no matter. The cash value of the policy still grows every year, no matter whether there's a loan outstanding or not. Now, you might be looking with a puzzled look on your face and think to yourself, but I don't want my child to be in debt when they finish school. You're right. Neither do I. So, hear me out. This is the financial education that your children need to know. There's a difference between being in debt and using credit. Being in debt means you have an obligation to repay, usually in the form of monthly payments or periodic payments of some type. And nobody wants to saddle their children with the stress of debt prepayments right after they enter the workforce. Now, getting a student loan is debt because your child has an obligation to repay that. And usually it's in some type of monthly or periodic payments set by the bank or whoever they get the loan from. But a loan against a life insurance policy is actually credit because there's no repayment terms. They can and should pay it back so they can use the same credit later on in life to, say, buy their first home, start a business, whatever. But there's no obligation to pay it back. Having your children understand the difference between debt and credit, especially at an early age, is priceless. And so is having an asset they can use to access credit throughout their lifetime. It's something an RESP just cannot provide. So for more information about the infinite banking concept and how it can help you, your families, and your kids go to school, I'd suggest you to watch this previous video and use the link in the description below to be connected to an IBCanada authorized infinite banking practitioner near you.